Good afternoon, everyone, and welcome to another session of Unlock the Stock. We are pleased to welcome Barloworld to this platform, which is specifically designed for retail investors to gain access to corporate management and to get to know those companies just a little bit better. Unlock the Stock is only possible with our technology partner, Lumi Global. Their website is lumiglobal.com, and you can visit it to find out more about their various AGM and investor presentation solutions, which are all held online. Our host today will be the Finance Ghost and Mark Tobin of Coffee Microcaps, and they will be facilitating the Q&A session at the end of the presentation. The event is sponsored by A2X, a stock exchange playing an integral part in the progression of the South African financial markets. A2X is the second largest stock exchange in Africa, if measured by market capitalization, with 176 securities listed on the platform, including 30 of the top 40 stocks with a combined market cap of 10.7 trillion rand. For those of you who have been following Barloworld, you'll also know that they recently had a secondary listing on A2X. The team at A2X are proud to be partnering with Unlock the Stock, just as it unlocks value through insights and key analysis. A2X unlocks value for stocks listed on their platform, helping to drive the financial markets forward. We would really like to welcome Dominic Sewela, the CEO of Barloworld, who will take you through a presentation of Barloworld. But before we start, just a few housekeeping notes. We start today with a video from Barloworld. Dominic will then take you through the presentation, and we will then do a Q&A session. Please note that you'll only be able to type your questions into the chat function at the bottom of your screen. The event will be recorded and will be available on the Unlock the Stock YouTube channel next week. When we get to the Q&A session, you will see an email address if you would like to be part of the Barloworld contact database. So please just take note of that address and write it down. Andre, I think it is time for you to share the video with us, please.
Ours is a story of vision and resolve, of bold pioneers who stood at the foot of Africa, imagining growth and progress across the rugged plain. Today, 120 years later, that vision finds expression in Barloworld, a leading global industrial processing, distribution and service company, headquartered in South Africa, branching out globally. Anchored in innovation, powered by a desire to make a difference in business and society, we create enduring economic and social value for our stakeholders by building businesses that serve industrial customers. Our proven ability to develop and grow businesses across the globe with high growth prospects. To drive ambitious growth across all businesses and within all markets, we implement a robust strategy designed to balance short-term action with longer-term value creation. Ongoing optimization of our business portfolio, coupled with acquisitive growth, ensures enduring economic and social value for our stakeholders. Beyond business, a distinct set of values and standards anchored in a culture of collaboration informs our very essence. Every day, in every way, we strive to make a difference in our businesses, our societies, and our communities. By celebrating diversity and opportunity, we inspire and drive social upliftment, enhancing lives and livelihoods wherever we operate. But what is it that defines Barloworld? What characteristic beyond African heritage, beyond rigorous growth, beyond exemplary implementation and world-class service sets us apart? In a word, people. A diverse and inspired workforce of engaged, high-performing leaders and teams whose collective talents and passions implement our shared purpose. Looking back over the decades, ours has been a story of determination and tenacity, of development and expansion, and sustained relentless growth. And now, as we embrace a dramatically changed economic and social landscape, we at Barloworld stand proud. confident in our ability to meet the challenges of the future with the same resilience, the same passion, the same unwavering determination as we continue to build and strengthen our win-win partnerships with all our stakeholders across the world.
That was a lovely introduction to Barloworld. I'm going to hand over to you, Dominique, so that you can take us through more of the details.
Thank you very much, Vanessa, and good afternoon to all the participants online. If we could move to the next slide, please. Thank you. I think in 2017, when I was appointed, as the CEO, we embarked on a new strategy to say, how do we ensure that we can bring about focus? We can make sure that we are able to deliver value as an organization. We've crafted a strategy, and I think simply put, there were three, facets of the strategy. It was to say, we want to fix businesses that are not actually optimal or not meeting the required potential, is to optimize those that we felt they are running relatively well, but in terms of returns are not meeting, our hurdle rates. And then, therefore say, once we've done so, we'll believe that we earn the right to grow and start focusing more both on organic and inorganic growth. But fundamentally, for us to be able to deliver on those, it was very important that there is a cultural shift that emphasizes high-performance culture in the organization, and that would require that, as a corporate center, we are become more activist in the manner in which we manage our underlying businesses. If you move to the next slide. Because once you've set out the strategy, what becomes important is executing on the strategy and delivering on the strategy. And we quickly, decided that we couldn't fix certain business within the time frame that we had. Like, for instance, we had our Iberian business already exited, in 2018. And we also have to focus on de-risking the pension fund, because we had a legacy pension fund in the UK, which is a defined benefit fund. And it was really, creating havoc in terms of, the movements of the underlying assets, not matching the liability that we had. I'm glad to say that, that has been put behind us. We have gone through a buying process of that pension fund, so that it don't actually affect our earnings. But of importance, during a very challenging time of 2020, we are bold and brave enough to make acquisition into Mongolia, which is a Caterpillar dealership, but also, in diversifying, a very cyclical business of distribution in equipment. We also got into food business where we acquired Ingrain. I think some of you will remember that there was a time where we invoked material and adverse clause, and largely because COVID was an event that was unprecedented, for those who are were in the market. But that also helped us to actually hasten our execution. We're able to partially exit in our automotive business. We sold 50%, and the reason why we did 50% at the time, we couldn't see, us extracting full value for that asset. Therefore, we believe that, at the right time, within the next, 18 months to 36 months, we'll exit the final 50% of that investment. Last year, December, we were able to successfully unbundle and separately list Zeda on the market, and we've also disposed of our logistics business. Now, when you look at where we are well placed and well poised, to be a business, if you go to the next slide, that fundamentally has got two pillars. Our Ingrain, pillar, which is more ingredient food focus, as well as our equipment, distribution and industrial services, which is really, anchored on Caterpillar distribution business. These are the businesses that our view, are the platform for growth going forward. Because in those two businesses, particularly the equipment business, there's a lot of organic growth, that is inherent in that business, albeit cyclical from time to time. However, on the other side, our Ingrain business is a very stable, business, as demonstrated, by its performance over a very tough period of 2020 during COVID. If you move to the next slide. We had very clear metrics and guidelines. One of the key metrics that we used was ROIC. You could see that, all our businesses are actually, achieving, returns above, the hurdle rates, save for Ingrain, and largely because when you acquire a business, and a business, with the moat that business has, with the attributes of cash generation that it has, you will pay, a premium, because you wouldn't be able to find an asset like that without paying a premium, and therefore there is goodwill, that is in the business. So you've got to work that goodwill over the next 3 to 4 years. And my view is that business is well on its way, to be able to reach its target. But what's important is that when you look at the investment thesis that in acquiring this business, that business is performing well ahead of our investment thesis in terms of cash generation and cash conversion. And so I'm pleased that overall, the drag that you see in the groups, returns, will change as well. So overall, our portfolios are generating the right returns. If you move to the next slide. So overall, if you look at the journey and the history, you can actually see that, say, for 2020, when you look at just, the returns, we are able to achieve ROEs, well above our hurdle rate. You see last year, September, we achieved 17.7%. And to March, it was 19.3%, if you're looking at periods on a comparable. These are returns that have never been really achieved over the years, and largely because we took our time as we simplify the business, as we focus the business to say, how do you really ensure that you're able to squeeze, better margins out of these operations? How are you making sure that you're efficient and you eliminate waste? And our Barloworld business system, drives, that culture. It is a Kaizen-based, Japanese, system, which is lean-based, and we have been rolling it out over the last, 4 years, and is taking root, in our business, and we believe that, we'll even begin to see more, and we're seeing its effect as well in our recently acquired businesses in both Mongolia as well as Ingrain. If you move to the next slide. I think what is important over the years is that, when you are in a cyclical business and being in an emerging market where the cost of funds are very high relatively compared to first world markets, it becomes very important that you have a very conservative balance sheet. Therefore, when you look at our covenants, even during COVID, we're able to withstand the storm. We've unbundled those businesses that, were very cash hungry and capital intensive, so you could see that, the current portfolio that exists is a very resilient one. And as the interest rates are rising, we will still be able not only just to grow organically, but we'll be poised as well when the opportunities present themselves, when we do find assets that fit the two, verticals. On a programmatic basis, we will look at opportunities in that regard. If you move to the next slide. I think what is important, particularly for investors in general, there's some investors who look at capital appreciation as the only reason, to invest, because you buy a share of the business, you hope the share price goes up. But in reality, it doesn't work like that. It is very important to look at a company and says, if I were the owner of this business, am I getting a better return, intrinsically out of this business? And as if you look at the time horizon, it was very important for us to distribute capital back to the shareholders, because we felt that if you're generating returns below hurdle rate, shareholders are better placed in getting that money and investing it themselves. And only our view is that, we can only retain shareholders' money when we believe that we can do better than they would. And to that extent, you can see that we, deployed special dividends. We also deployed share buybacks. And with unbundling of Avis, it was a dividend in specie in December last year. So we are very focused on capital allocation, because we believe that if you look, shareholders should look at a total, shareholder return, where you look at both capital appreciation as well as dividends or distribution and how the capital gets allocated. So if you look at the growth of the value to the shareholders on that basis, Barloworld has done significantly well, in terms of allocating capital. So if you move to the next slide, I think looking forward, obviously there are headwinds, and Russia-Ukraine, situation does present significant headwinds, but we've de-risked that, entirely because we've been able to extricate cash out of the business prior to the war. We've taken a pain in terms of impairment, and we continue to operate in an environment, albeit very tough, because we need to comply with the sanctions. Our view is that we need to take a long-term view. It's very uncomfortable to operate in a war environment, but given the fact that we've been around for 120 years, and our view is to take a look at saying we should be around for another 120 years, and hopefully over the time we'll be able to withstand challenges in various geographies that we operate in. We continue focusing on a strong balance sheet, particularly in an environment where interest rates are rising, and it depends on who you talk to, but they could still be rising further than where we are. Some of us have been around long enough to remember days when, in the late 90s, interest rates went to as far as 25% in this country. I hope they don't get to that level, but if they do, business people like ourselves should be able to say we've thought about that and how do we fund our business. I think when there is this type of uncertainty, organic growth makes sense at all times. And to an extent where there are opportunities, you also like to look at inorganic growth. In terms of making sure that you don't overpay for assets. And we're thinking, in this environment, valuations are becoming interesting. To pique our interest, and to an extent that we'll find those opportunities, we'll pursue them. But also, it's important to say, being a good corporate citizen, you cannot neglect the issues of ESG, not just only the E, but the S and the G as well. And as a company, we make sure that we've got a very good balanced look at all these areas, because you cannot just harm the environment, but you also have to make sure the communities where we operate in, we leave them better than we found them. And but also making sure that, being a publicly listed entity, from a governance point of view, we are transparent, we are ethical in the way we conduct business. I will stop at this level and allow questions. Thank you.
Thank you so much, Dominic. That was just such a lovely overview and delve into how you are looking at positioning and running Barloworld. So thank you very much. I'm going to hand over now for the Q&A session, which, as everyone knows, is facilitated by the Finance Ghost and Mark Tobin. And as a reminder, please pop your questions into the chat function at the bottom of your screen. So over to you, guys.
Thanks, Vanessa. Thanks, Dominic. Dominic, I just wanted to maybe just go back to the structure, if we can, for a second. You've disposed of a couple of businesses over the last 12 to 24 months, and there's kind of two clear divisions remaining. If we look forward, the next 3 to 5 years, should kind of investors expect those two divisions to remain, and there might be bolt-on acquisitions, and obviously you mentioned organic growth, but there's no thoughts on divesting out of the logistics business to replace it with a third arm of Barloworld. Can we maybe just talk about that?
Yeah, I think one of the things that as business people is the ability to simplify and focus. And if you understand the history of Barloworld, we've always come from the history of being a conglomerate over the years. And therefore, various of my predecessors have gone through the process of unbundling and getting to the point where we are. And my view is that our core birthrights are in equipment distribution and industrial services, first and foremost. To that extent, it will be very important that we grow the platform in saying, if we are able to increase the size of the wallet, there could be opportunities to acquire more dealerships, but also acquire businesses that continue to service the customer base in that segment, because we've got a very good understanding of that customer base. Therefore, if in terms of value capture, it will be much more better to focus in that area. But similarly, when you look at mega trends that are driving growth going forward, the foods segment, and I'm here talking B2B, not B2C. For us, we found very interesting because it's a stable segment. It counterbalances our cyclicalities. Therefore, there are opportunities that will probably be adding, businesses that are are sizable in terms of size, programmatically to enhance, and make, ingrain, bigger than it is from a contribution point of view. And we will be focusing on those. But I think importantly, though, the opportunities also lies being outwardly focused other than South Africa, because currently we're quite South Africa centric, in many instances. If you look at the size of our equipment business in Southern Africa, particularly with the challenges that we're having in Russia. So we'll be looking at also saying, how do we grow organically in those opportunities? And hence I was talking earlier on that we have to have the discipline of fiscal discipline, that you don't actually buy for the sake of buying, just for the sake of growing organically. Valuations are very important. The price you pay determines your return. And therefore for us, we also like asset light businesses that are cash generative, and that will enhance what we've done. So you're likely to see some growth coming through over the next 5 years, but it will be within these two platforms. We won't be adding an additional vehicle.
Okay, perfect. Thanks.
Dominic, thanks for your time today. I'm going to jump in. I must thank you on a personal note for being a purveyor of the finest yellow goods. Toddler Ghost is obsessed with diggers, and especially big diggers. So in honor of my 3-year-old boy, I'll ask you a question about big diggers. And having read, Caterpillar's recent earnings, they talk about electric vehicles as quite a driver of ongoing investment in commodities and lots of different commodities. And obviously, when you're selling into the mining industry, ultimately, you just want them to be busy, right? You want them to be digging things, literally. It's as blunt as that. So I was just wondering to what extent, for investors to understand, does Barloworld have any exposure to those sort of commodities across your business? And maybe just to help investors understand, what is the look-through exposure in terms of your mining clients? Which commodities are most important in Barloworld's business, effectively?
Yeah, I think it's a very good question. And it speaks, when you look at our geography, one of the key issues that why we exited Spain and Portugal, we felt it didn't present the opportunity like, huge infrastructure development as well as mining, whereas when you look at Russia, when you look at Mongolia and the rest of Southern Africa, we've got a very great mix of various commodities, whether you talk about cobalt in the DRC, which is very critical in terms of, energy transition, when you look at copper, because it's very critical in terms of looking at energy transition. But the other one that a lot of people don't like talking about, coal, because it has actually gained, a negative, attachment in terms of being a major polluter. But for us to transition successfully into electric drive cleaner energy, we're going to need coal for the better part of, the next at least 30 years. If you're going to drive, electrification of vehicle, or if you're going to get more cleaner energies like wind turbines and all that. So I think, we are well placed as an organization in terms of infrastructure and the investments that we make to support, the mining houses. And we've got the major commodities like cobalt, as I've mentioned, iron ore, copper, as well as, coal. All the geographies where we operate in, there's still coal. And yes, it's cyclical. I think you've seen sort of a repricing that is, and largely driven by demand, because I think there are global headwinds in terms of global economy. But, in essence, we're well placed, to take advantage of any growth aspects.
Dominic, obviously you briefly touched on COVID in your presentation, and kind of post-COVID, it's taken supply chains a long time to kind of normalize post-COVID. And I mean, you're right at the pointy end of that being in, distribution and, working across many different borders and geographies. Where are we in that normalization of supply chain and logistics now? Would you say we're back to kind of 2019, kind of situation, or is there still, issues in terms of moving stuff around? China didn't really open up until, let's say, February, March, this year. Is it still a bit of an ongoing stress or problem for businesses in general and specifically Barloworld, or have we kind of now put that fully behind us and you can move stuff around, get stuff in, ship stuff at like reasonable prices, just in terms of that, because you are so ingrained in kind of logistics and distribution, especially in the equipment business?
Yeah, I think it's a very good question. I think when I look at some of the products that are coming out of China, because you procure equipment out of China for because Caterpillar manufactures in various geographies. I wouldn't say we are 100% there in terms of where we operate, but we've seen an improvement with products coming out of the US. But the first 6 months, if you look at our numbers, you'll see that we spend a lot of money in working capital. Largely, that was driven by the inefficiencies in the supply chain because we had to procure inventory, in time, in anticipation, that we are able to have it for us to be able to sort of sell it also in the second half. And that is the example of, say, where it got a bit sticky in terms of some of the stuff. We had to prepay Caterpillar to secure, equipment coming our way because, I mean, there were other, competing dealers in the US where they could easily get the product. So we were able to secure the product. And you'll see that unwind in the second half. And it speaks to the fact that it's not quite perfect, pre-COVID. There are still some challenges in terms of just availability, of ports. We find that, in our region, Southern Africa, we are able to move, parts, and machines easily. But Mongolia was quite challenging, because the borders were closed. Now we're seeing the movement of that border opening up between, China and Mongolia, and things are getting better, but I don't think we are where we were pre-COVID.
Maybe I can jump in here with another digger-related question. And this is more around the nuance of just understanding this mining cycle. So obviously, you talked about some of the commodities earlier. Coal features quite strongly. We've seen those prices come off. If you've held Thungela shares this year, you'll certainly know that. And I guess from your perspective, obviously the price of the commodities I would think is important, because if commodity prices really collapse, the economics of the mines fall over and they actually just stop growing. I don't think we're anywhere near there yet. If you have a look at the sort of EBITDA margins of these mines, yes, they've come down a lot year on year, but they're still very good. They are still absolutely making money. And I think the question I have is, or something I want to test with you is, when the prices are coming down, these mines need to drive volumes as best they can while the prices are still decent. Ignore the trajectory, just look at the absolute level. I would think volumes need to be driven now. And we've seen miners who have had volumes come off, they've had production issues. But for Barloworld, I would think that it is a positive that as long as commodity prices can stay relatively decent, these mines are going to push volumes as hard as they can. And you can only push volumes by getting the stuff out of the ground. And that's firmly where your business fits in. So is that a reasonable way to kind of think about Barloworld's exposure to the cycle?
Yeah, it certainly is, because when you look at our order book, as the last time we reported at about 5.6 billion, it is at a historical high, and largely it's because the mining houses, when they came out of 2008 global financial crisis, they really were tight on their balance sheet, and then they cleaned up now, but they didn't acquire equipment as much as it did. And then when the commodity prices, they now had to scramble to get machinery because some of the machines were aging, so you couldn't fix it, you had to replace it. So now we are into what I call a replacement cycle. Notwithstanding where the prices are, they still have to make sure that they remove the overburden. They make sure that they can be able to dig the ore body, because that's where the commodities are in that ore body. So we are seeing that, they have to continue to push volumes, as you're saying. But when, let's say, the prices were to collapse, then what they will do, they probably would stop some of the equipment for a while, and then you'll see, us, maybe, getting into a different cycle where we'll be releasing more capital. And for us, we don't like that. Even though we are now generating more cash, you find that, to have a cash conversion of more than 100%, it means, therefore, you're not investing in putting more equipment that you can harvest over time when the cycle gets busier. So, so I say you are correct in your analogy that we are going to be benefiting for a while, notwithstanding where commodities prices are now.
Dominic, can we just talk the impact of foreign exchange on Barloworld? Whether that's rand dollar versus, or ruble dollar. Just if because we have a lot of retail investors on here, but just to kind of give them like kind of a couple of rough rules of thumb of, is a weak rand good for Barloworld? Is a strong rand good for Barloworld? And if they're looking at rand versus other currencies, how it's going, I'm assuming dollar is a big one given the relationship with Caterpillar, but maybe just kind of give us an overview of like how we should think of big swings in FX rates, which we have seen definitely with the ruble, but also the rand has been like very weak. But if we get US interest rates coming down, we could see the rand going the other way very quickly as well. So maybe just kind of talk about the impact of FX on the business.
Yeah, I think that's a good question. What we've done in all the regions we operate in, because of various currency, our functional currency remain a dollar. So when we source equipment, in dollars, we try to get the customers, to hedge, because we price it in dollars. But when it comes to, so from that point of view, we are neutral with most of these mining companies because they also operate in those geographies and they are subject to this currency. So we are neutral at that level. However, when you look at the parts, because once you buy the parts in dollars and you now put it, in your inventory, that's where you get impacted, because, when the ruble depreciates, firstly, your translation is that, you'll take impact on your income statement on the tax line, and albeit not a cash outflow, but you'll take that impact, But similarly, in Southern Africa, because we've got all these regions, we are able to hedge. Obviously, we would prefer, a stronger rand, in that when we buy, but a weaker rand gives us a better translation of the revenues that we get, that are dollarized, in other markets because we have a South African based company. So when you look at Ingrain, basically benefit out of a stronger dollar, a weaker rand, in that, the pricing of maize is in US dollars, and because you're looking at, Chicago Board of Trade, that's where the pricing of maize, is. And then, because we also have pricing power, we are able to pass through that, to our customers. But whilst, we realize that, being dominant, we have to use that pricing power very responsibly, that, we do not, gouge, because the product we produce is very sensitive, to consumers. So I think, overall, we would prefer a stronger rand, if I may put it that way, because the bulk of our business being in this region, but, you can see though that the rand has been quite volatile. And you can see when you look at our numbers, to March is reflective of that Forex line, and on the interest line, largely because our funding of our inventory is through a floor plan with Caterpillar, which was dollar-based, and therefore you had two effects: interest rates rising, dollar increasing, therefore our cost, to finance the Forex was high.
Yeah, you get the double whammy of the interest rate and the FX. Okay.
Yeah.
I'm starting to get some good questions in my DMs. And Dominic, I'm glad you've touched on pricing power, because I got a question that is a little bit along those lines. I just want to broaden it slightly, and I want to just talk back to that ROE chart that you shared in the presentation, which showed that very big jump in 2022 and 2023 versus even pre-pandemic levels. I mean, it kind of tells a story that Barloworld is a strong place to be, on one hand, in an inflationary environment, but obviously also in a stronger commodity environment. And I guess one of those is maybe more cyclical than the other. Inflation, I think a lot of people are kind of expecting it to be a little bit higher for longer. Commodities, who knows? And the question is, to what extent you can talk about this? Are you seeing your organic growth being based on price increases versus more of a volumes growth story within the organic story at Barloworld?
Yeah, I think if you look at our equipment business, there is a growth story around volume, and I spoke to the fact that, at 5.6, it's a historical high in terms of the order book. You see that, that's basically, been the case, in our equipment business. But when you look at, our equipment Russia business, to March, there it has been a price growth in the sense that, because the supply and demand of aftermarket, we're able to push our prices. Also make sure that we can mitigate the weakening of the ruble. So you'll see the margins in that geography, is disproportionately higher than in Mongolia and South Africa. So in the main, there is been there. But I think what a lot of investors are probably missing is the work that we've done during 2020 in streamlining our business, in simplifying it further, and putting simpler processes to make sure that we can serve the customer better by lowering our costs, but also making sure that the customers are willing to pay the premium for being able to get quality products from us, turnaround time. And you'll see that in our margin expansion in all our businesses, relatively based on the historical, verticals that we had, like Avis and motor retail and logistics. So I think, we are well placed to sustain this level of return and to be able to absorb any shocks, if margins comes under pressure.
Dominic, you mentioned Russia there. I got a question here on, I'm also going to broaden it a bit, just how you're kind of navigating, the relationship with Caterpillar, given, you work with them, in Russia and Mongolia, Southern Africa, you've got like a very strong relationship with them across multiple geographies, but obviously they're a US-based company, having to deal with, sanctions on one side, and, you still got your business operating in Russia. Maybe just talk to us about, how you're kind of managing that relationship and working to be compliant, with the sanctions that are in place, while at the same time, trying to, service customers in that market as best you can.
Yeah, and I think, ours is more complex than just, Caterpillar, in the sense that, we've got an entity in the UK, so we operate out of the UK. And we also have to comply with the sanctions in the EU, as well as the US sanctions. But being in Russia, you also have to comply with the local, legislations there. So it becomes more complex. So it's not easy, to be honest with you, operating in that environment. And as sanctions are being, introduced, you have to adjust, because currently you can't actually, source, Caterpillar product, into that environment. So what we're living off is basically, used products, and being able to source parts. But in the main, we are only providing to customers that we can support in terms of non-sanctioned customers. So if those customers shrink, obviously, our ability to service that market shrinks as well. And hence the guidance that we've been giving to the market is that we will do everything to make sure that at worst we'll break even in the business. But you saw with all our initiatives, we did better than break even in the first half. But the longer this war goes on, and obviously we'll continue to evaluate, that we do not want to have a situation where we can run the risk of non-compliance with sanctions, nor run the risk of being value destructive in the environment. So it's something that we watch, but as I say, it's not easy operating in emerging markets in general. But it's one geography after the other, hopefully, we wish and hope that this war ends, and it doesn't mean if it ends necessarily the sanctions will be taken away immediately. That could be a bit of a lag, but we hope for the sake of humanity overall that the war ends.
Dominic, I've received a question here that I don't want to spend a lot of time on, but I think it is important because I think sometimes investors get confused about this stuff. I must say, I haven't followed the Kula Sizwe BE scheme very closely. I know it's a property deal, but I think it was also related to a lot of the motor retail properties. I think maybe just 2 minutes on, given all the restructuring at Barloworld, a Kula Sizwe BE investment is not related to Barloworld's underlying operations. You're not buying the yellow metal stuff. I think just maybe 2 minutes, just clearing up any confusion that might exist in the market around that.
Yeah, I think, just to clear that, because we had done a deal before that was a deal which was linked to our shares, and that deal was underwater. And we felt that, of course, it was imperative that we do a BE deal. The structure of the deal that then becomes important, that we delink, that deal to the share price. And the property portfolio of Barloworld was best placed to be utilized, that, the shareholders will be able to raise capital, which capital they did actually pay to Barloworld for these properties, which capital we then used to buy back our shares, because we didn't want to be dilutive to the shareholders of Barloworld by doing a BE deal. And so as we unbundle businesses, as we sell the businesses, Kula Sizwe still benefits, because I think the structure was a 10-year structure. The leases are for a 10-year period. So those leases will remain in place. So NMI will continue to pay Kula Sizwe the rental, Avis continues to do that. But what is good for us, I think you'll see it in the next couple of months, we'll be able to deconsolidate Kula Sizwe from our numbers, because currently, it actually clouds our headroom, because the debt structure, it looks like it is the Barloworld debt structure, because we had to give certain guarantees in rental payments. Now Avis is doing that directly to Kula Sizwe, NMI is doing it the same. So there's a small portion that relates to equipment properties of the Kula Sizwe, BE scheme.
Dominic, we've spent a lot of time on the equipment business. I do want to look at Ingrain a bit for a while. If we look at the last results, exports from Ingrain actually did, quite well. Can we maybe just talk about, and I'm sure that's one of the strategies maybe to, improve the return on invested capital there, get volumes up, get exports up. Is that one of the strategies to, one, improve return on invested capital, but to focus to, get more exports going in the Ingrain operation that maybe, weren't really there before you guys made that acquisition? Is that one of the focuses? And, to what would the mix you would like to see in terms of, domestic B2B sales and export sales from that side of the business?
Yeah, I think it's a very good question. I mean, we definitely want to grow, our export, particularly in Australasia, and in the East, as well as into the rest of Africa. Because if you think about it, there's only two, starch producers in Africa. It's a whole continent. It's production out of Egypt, as well as out of South Africa. Therefore, all the other starch that is consumed in the continent is imported, and sometimes it's not easy for starch to travel long distance. So it makes a lot of sense for us, to make sure that we debottleneck our plants and also increase efficiency, because the previous owner of this business really didn't put a lot of capital in terms of maintenance, so the plants were not reliable and efficient. And that's been our biggest drive. So for us, Chris is really focused on making sure that as we roll out BBS, they eliminate waste and the efficiency comes about, that we can then get more volume, not just for domestic market, but push, for export as well.
Mark's going to hate me for going back to the equipment side, but I did get a very good question on this, if you don't mind, Dominic, and it's around the order book. And I guess it's around understanding the underlying drivers of the order book, which looks very strong in Rand. So the obvious first point is, the Rand has weakened. So to the that's a point that's worth mentioning. There's also the inflationary impact of the actual pricing of the underlying product in that order book. And then one of the other factors could, of course, be the mix between more expensive equipment and cheaper equipment. And the question is around, to what extent can you give a little bit more information? Because I refuse to say more color, because that's for American analysts. It drives me mad when I read those transcripts. A little bit more information on, the number of units inside that order book. What is actually driving the growth there? Not just the Rand number, but a bit more.
Yeah, I guess the two biggest driver of an order book is lead times, and number one, because when I can have a construction piece of equipment, we try and put that on the floor. We take risk on those because, the movement of those products tends to be faster. It's about 3 months inventory that we try and keep for, so that a customer that gets a tender to do a job can be able to find the product readily available. However, you can't do that with mining products. So that order book mainly is mining and contract mining. And it's big order items. And because when you buy trucks, you don't buy one, you buy a fleet of those. And to the point, the fact that we also say we are hedging and we sometimes sell on a dollar basis, so there's no risk, even if there is a Rand depreciation, when you look at that order book. The only time that order book goes down is if there's no demand coming through and we're delivering against it. But over the last 2 years, it was high and it's gone up, to March. It will probably slightly correct downward because we'll be delivering most of the order in this next 6 months. But there's still a pipeline, to next year, next financial year, that, because we know the lead times of when some of these, equipments will arrive. Hence customers give us an order, this firm that they commit to, we require deposit in some instances. If we believe the product is difficult, should they cancel the order? I think, that's what maybe let me pause here.
Dominic, just one on, debt levels. I think there was a point in your slide about, you want to reduce debt levels, even though you're a long way away from covenants. Maybe just talk about that. What's the level the board is looking at, or you want to kind of get it down to? I appreciate there's probably always going to be some level of debt within a business like Barlow.
Yeah, I think in terms of the targets that that the board has set is about 60-40, split between debt and debt to equity. But when you look at our debt levels, too much, largely is it's just working capital. So you'll see as we unwind that, that we are quietly a low level debt kind of business, because other than, what we've invested in Ingrain, and some of the losses that we've taken through, logistics, as well as, recapitalizing Avis just before unbundling, there's not much debt that sits on our book, save for working capital debt.
I want to ask something around the economics on sort of the aftermarket parts side. So I think that's something people need to understand about Barloworld is, at the moment you're selling a lot of heavy equipment and the order book is strong, but actually there's a benefit for a few years, right? Because there's the aftermarkets business, and the more big, exciting diggers that are running around out there, the more parts they need and the more that you guys can service them. So I guess a little bit of understanding around the economics there, and then linked to that, something that Caterpillar is pushing quite hard is their direct-to-consumer strategy. And I'm not sure if it's for the more remote areas. They do this thing where they ship the equipment, with a QR code, and you can go and get all the parts listings. At least that's what they say in their earnings transcript. So I'm just keen to understand from a Barloworld perspective, your aftermarket business, and, is there a threat of disintermediation in that side of your business?
Yeah. That question, let me start with the last one, because every new board members, when they get to our board, they always ask, is there a threat of disintermediation? And no, there isn't, because if you look at the cash-to-cash cycle of Caterpillar, their dealer model works very well, because the dealers have invested heavily in terms of infrastructure on the ground. So even if you were to order that part, directly, it's going to be delivered through the dealer. So the dealer still gets the margin, and I guess, because of global customers, they like to negotiate prices, at a particular level, because they want to get a benefit. So Caterpillar, along with us, we deal with these customers in various regions, and therefore we do have, a factor, which is country-based, factor, where we factor how complicated and difficult it is, logistically, to move some of those parts, because Caterpillar will not be able to send that part necessarily, directly to the customer without having the infrastructure on the ground, that the dealers have built up. So I think that, puts that aside, ourselves and Caterpillar, in many ways, are joined to the hip in making sure that the customers, get a better service and are satisfied. And there's also, other than the part, you still have to have a technician who can troubleshoot and fix these machines. So, and that, that skill sits with the dealer. So I think, that's one other thing. Just remind me again, what was the first one?
The useful life.
Okay, the useful life. I think, if you look at a construction machine, a useful life of a construction machine is between 5 to 10 years. And a mining, machine useful life is about 10 to 20 years, depending on how they utilize, because it operates over 24 hours. And that for us is very important, because it gives us an annuity income. But as long as these machines remain in what I call in channel, in the geography where we operate in, we are able to actually harvest the aftermarket, and which gives us the annuity income, particularly when you see the downturn where customers may not be buying, but they continue to utilize these machines and they need to be repaired, so availability becomes very important, particularly in the mining sector.
I mean, I just quickly want to check my DMs, and I think we've covered everything from my side. Ghost, have we covered everything on your side, or is there still one or two?
I have one left that I think is half a joke, which is, you think Elon Musk might enter the sector with Tesla diggers. I'll leave that one as a funny comment to end off our day, rather than a serious question. But I think my DMs are good to go. We're done.
Thanks, everyone. That was a great discussion. So thanks to everyone who participated on this Unlock the Stock session today, and a real special thank you to Dominic and his investor relations team at Barloworld for making the time to support this investor platform and to engage with the retail investors. We really appreciate this. We hope that you've enjoyed the event, and just as a reminder, it will be up on the Unlock the Stock channel later on during next week. And then please do look out for the next session of Unlock the Stock, which is taking place next Thursday, the 31st of August, and that will feature Curo. So please look out for that. Thank you, everyone, and goodbye.